You're about to sell an investment property and you're thinking, sweet, I'll just roll this into another one and not pay taxes. Totally fair thought. That's the magic of the 1031 exchange. You sell one property, buy another, and defer the taxes. It's like hitting the snooze button on your tax bill. But if you mess up even one detail of your 1031, you could end up with a surprise six-figure tax bill. In this video, we're breaking down 3 of the most common ways investors accidentally destroy their 1031 exchange without even realizing it. Let's get into it. Let's start with the cash out refinance. This one is sneaky and it gets a lot of people. Say you're planning to sell and a few months before listing the property, you pull out a bunch of your equity through a refinance. You might be thinking, I'll just take a little cash off the table, no big deal. But here's the problem. The IRS sees that and calls it a step transaction, which is just a fancy way of saying they don't believe your refinance and your sale are 2 separate events. They see them as one big maneuver to dodge taxes. And that cash you pulled out, that's taxable boot. It's no longer part of the 1031 deferral. So instead of rolling everything into a new property, now you've got a tax bill on what you thought was a cash out refi. Timing is everything with a 1031. If you want to refinance, do it well before you've even thought about listing the property. Generally, that means waiting at least 2 tax years after a refi to sell the property in a 1031 exchange, or waiting until after your exchange is done and the new property is closed. At that point, you can refinance. Next up is taking title differently. This one sounds like a tiny technicality, but it's a tiny technicality with a massive consequence. In a 1031 exchange, the taxpayer that sells the original property must be the same taxpayer that buys the replacement property. Sounds straightforward, right? But here's where it gets tricky. Let's say your current property is owned by you, but when you buy the replacement, it's part of a syndication where the syndication is taking title. Because your name was on the title of the property you sold, but the title of the new property is in the name of the syndication, the IRS sees these as 2 completely different taxpayers. It's like showing up to a passport checkpoint with a different name on your ID. Even though the photo is you, the name is different, and instead of missing your flight, you're paying hundreds of thousands in taxes. This also trips up people who are in partnerships and want a 1031 into their own properties after selling the partnership property. Generally, in situations like this, you would want to quitclaim the deed from the partnership into your individual names or individual LLCs, and then hold title this way for 2 years, at which point each partner can go their own way and complete 1031 exchanges into their own properties if they wish. And the third mistake when it comes to 1031s is not using a qualified intermediary. Here's how it works. The IRS doesn't want you touching the money. If the proceeds from your sale hit your bank account, even for a second, the 1031 is over. You just turned what could have been a tax-deferred exchange into a fully taxable event. That's where a qualified intermediary or QI comes in. They act as the middleman. They hold the proceeds from the sale and then use those funds to purchase the replacement property on your behalf. They're not there to give advice or help you pick properties. Their job is simple: to keep your hands off the cash so your 1031 stays compliant. Also, in most cases, you'll need to send your list of potential replacement properties for the 1031 exchange to your QI by day 45. So don't miss out on that. All right, let's do a quick recap. First, refinancing right before selling can lead to taxable boot. The IRS may treat it as part of your sale and you'll owe taxes on the cash you took out. Generally, the best practice is to refi at least 2 years before a 1031 or after the 1031 is completed. Second is to make sure the entity selling the property is the same one buying the new one. Don't switch from a partnership to your personal name or vice versa. The IRS will see that as 2 different taxpayers and disqualify your exchange. Third, always use a qualified intermediary. Don't let those funds touch your personal or business account, because once they do, the tax deferral is gone. If you're still with me, that means you care about getting this right, and you should. A properly executed 1031 exchange can save you hundreds of thousands of dollars, but it only works if every little detail is handled correctly. If you found this video informative, hit that subscribe button, and if you're planning a 1031 exchange or even just exploring the idea, reach out to talk with a real estate-focused financial planner. We'll help you do it the right way so your money keeps working for you instead of the IRS. All right, I'll see you next time.